Today's mastermind is going to be all about buy and hold investors. So I want to kind of cover some ways that you can analyze an investment, understand the investment, but also how do we help an investor, especially novice investors, to understand the investing potential, what the costs really are, and then how do we help ourselves stand out in working with investors. I'm an investor. I love being an investor. I think you should all be investors as well. If we're in the real estate industry, then we come across phenomenal opportunities, and I want you to be able to take advantage of those in a positive way when those opportunities arise. And so I do want you to understand how to analyze investment. See, there's a lot of people in the real estate investing world that just kind of wing it. They don't really have a lot of they know that real estate is a good investment, and they kind of understand that real estate is a good long term hold, and it's gonna appreciate over time. They understand that just residential real estate has appreciated by 4.4% a year for the last 50, 60 years, kind of thing. Now we've seen much higher appreciation for the last 4 years than we have historically, but that's not going to be normal. Normal is going to be 4.5% roughly. And so, what you find is that there are different investments that carry different returns. And so, normally your bonds are going to be some of your lowest returns, and then above that tends to be real estate, and then above that tends to be the stock market. Just when you're talking about general returns on investment. That being said, especially in the real estate world, you can do better than the stock market if you understand what you're doing and how to analyze investments and those kind of things. For a lot of novice investors, they just take that 4.4% a year, and that's kind of what they really expect and think that's really going to happen. So when you are ready to start investing, or when you're ready to start working with someone to help someone to be an investor, I think it's very, very important that we discuss with our investors, like what's actually going on. And the first thing is that all investments carry risk, and both you or your investor have to understand what those risks are, and then that risk is what's going to kind of lead you and lead them into what level of investing do they want to do. And what I mean by that is if you're looking to do a lot, if you're high risk, if you're very tolerant to risk, are you willing to put a second mortgage on your home in order to go and do that? Or pull out equity? Or are you willing to take all your savings out and do an investment? Because we have to understand that all real estate investing has a risk that goes along with it. I think that it would be foolish of us not to make sure that our clients really do understand that there's no guarantees in real estate investing. You can lose money here. And so understanding what your client's level of risk is really crucial in order to help them find the right investment that may better match up with their skills as well as their goals. The other thing so the first thing is to make sure that our investors understand investing is a risk. And I know that this is much more of a conversation for novice investors. For our newbie investors, make sure they understand that. But then in addition to that, we have to kind of explain the process as far as what, what is your investing goals? And the reason I say that is because there's a lot of investors out there who say, I just want to do good. I just want to make some money. I just want a decent return. And that doesn't that kind of answer is nothing that I can help you with. And what I mean by that is it's kind of like, the Cheshire Cat, Alice in Wonderland. Alice walks up to the path in the road, and the road goes two ways, and she's like, which way should I go? And the cat says, well, where do you want to go to? And she's like, I don't know. And well, it doesn't matter which path you take. And the same thing kind of goes with investing here, is that we have to understand what our clients' goals are. But a lot of our clients don't have true, hard, specific financial goals. And so Probably the one of the most important ones that you talk to your clients about is going to be what's called IRR, internal rate of return. And so this is, in a nutshell, this is what you want your money to do for you. This is what kind of a return that you expect from an investment that you make. This is, the metric that provides enough insight so that we understand how profitable we expect our investment to be. And so some folks will refer to this as the future value of money. And basically what it means is if I had $100,000 to invest, I mean, just as a round number, how much would I expect that investment to return to me? And then, like that number, that's the number that you really got to understand. And some folks, and your internal rate of return is going to go heavily along with your level of risk. So some folks will be much higher risk, and so they'll want to see much, the potential for much higher returns. They're also going to have the potential for greater losses, but they could have high returns on there. We see people do the same thing in the stock markets all the time. It all works together. For a lot of your real estate investors, if they want something very safe, well, that may only get a 5 or 6% return. So their internal rate of return would just be a 5 to 6%. If you go out and you invest in drugstores, those kind of things, the CVSs, those things, you can normally get 5.5% return on your money on those. Other investments, you might be able to make 8 or 10%. But if you don't have, for a lot of investors, it's 8, 9, 10, some are 10, 11, or 12, but those are tough to reach. Those are going to be much more high risk investments if that's what you're willing to do. Because see, the risk thing carries forward, especially in real estate investing for cash flow properties. And what I mean by that is some of the best returns that I have are in properties that are a giant pain in the butt. And so, for some folks, like, they enjoy working there and can and have no problem kind of engaging and they'll stay right on. They'll do a really good job of managing their tenants, that kind of stuff. For me, that's a lot of headache that I don't necessarily want to have. Properties that have a higher return always have a higher risk for me, and the same thing goes through across the board on real estate investing. You have your different classifications of real estate property, A, B, C, and so an A property, is very low risk, and if it's very low risk, it's going to be lower return. So you can have a beautiful property in Buckhead in the prime area, and you're going to see those returns are really not great. Now, one of the best properties I have as far as a return on investment is in East Point. And I tend to change tenants there almost like underwear. It's just a very transient area. It sits right on a bus line. But this is also a property that I spent $38,000 for about 10 or 12 years ago. It's paid itself, and I make an amazing return on that. But it's a giant pain in the butt. This is a property where I have to replace windows and utility, and appliances, and it has to get painted every single time. So it's one of those where it tends to be higher risk. It also has a much higher return. And the reason I'm bringing this up, and I want to carry this all the way back to this internal rate of return, I need to know what your goals are for return as an investor. I want to be able to explain to you that, the low risk properties don't have high returns, but the higher risk properties do. What is your level of risk? What kind of return is it you're wanting to make? Everybody wants the low risk, high return properties, but that doesn't really work out there. What you see is that higher risk, higher return, lower risk, lower return. And so we want to make sure that we're clear in articulating that. And everyone all investors kind of work out to what is that equilibrium that they want to be, where this is the level of risk I'm okay, and this is the return that I want to see from it on the other side. So, having that number, and for you, you can kind of think the same thing. If If I invested $100,000, would you want $8,000? Would you want $5,000 for your money? Would you want $15,000 for your money? Because at that point, if I want $15,000, that's a 15% internal rate of return. If I want $10,000, it's a 10% rate of return. If I want 5,000, it's a 5% rate of return. So I'm just trying to give you a way to kind of get your head around it, because your investors, if I don't know, you as an investor, if I don't know how much money you want to make on investment, how can I help to find the right property for you? And sometimes we have to take our clients through this process, because a lot of times I'm sitting here on cash. It's not making a lot of money for me. I want to invest in real estate, but I don't know. Please start off talking about what is their internal rate of return. What are they going to, like what kind of return do they want to make, and what level of risk are they ready to undertake? Now, the other thing that we have to really look at here, especially in the education process for our investors, is we have to explain a lot of different terms and calculations. Now, there's a lot of folks in real estate who's like, I don't like numbers. I'm not good with math. Well, suck it up, buttercup, because if you're going to be doing real estate investing, you're going to have to figure out, and we're not talking like complex math equations here. Okay. We're talking basic math, but you do need to know some of these basic calculations when it comes to, especially residential investment, residential real estate investing. There are a few terms I really want to kind of walk through with you to talk about those, so that you're aware of them. And because not all these terms are going to apply for everybody, but a lot of these terms, a lot of your investors will use these terms, especially more of your seasoned investors. And sometimes you're just going to have to kind of explain that to your different clients. So now that we got past internal rate of return, I want to talk about the next one is what's called gross rent multiplier, or GRM. And on income producing properties, it's not going to be used for flips, only for buy and hold properties kind of thing. In order to calculate what your gross rent multiplier is, all you're going to do is take the total purchase price of the home divided by what its annual rent is predicted to be. And so, first of all, let me be really clear that there is not a right number here, right? And so the lower that number is, the better the return is. But also, the lower the number is, generally speaking, the higher the risk is. And so what I mean by that is you may find someone that is to where their investing goals, especially for seasoned investors, I need this kind of gross rent multiplier on my properties. I'm comfortable handling this level of risk. And other folks, it's going to be like my number is, my gross rent multiplier tends to be higher than, say, Mark's gross rent multiplier number, just because he's comfortable taking a little bit higher level of risk in order to get a higher level of return. That doesn't mean that lower is necessarily better, but that helps me as a real estate professional to be able to guide my clients in to finding the right property that matches their level of risk and return. And so that term is GRM. And so these terms, we're going to put these into practice here in just a minute. This is not something I want you to be able to just kind of not think about. The whole goal here is that by the time that we wrap up today, I want that you can be able to analyze a buy and hold investment, share that with your client, or share it on social media, talk to folks about it in order to go generate and build some business. So GRM is our first term that we're going to talk about. Next one is the 1% rule. Now, 1% rule has been in residential real estate for a long time. It tends to be harder to hit the higher the purchase price of the property is. But all the 1% rule says is that if I have a home and I buy it for $200,000, I should get $2,000. I mean, $200,000, I should get $2,000 in rent. You want that the gross rent is equal to 1% or greater of the total acquisition cost or the purchase price in there. So I buy a house for $190, I should collect $1,900 in rent. I buy a house for $150, I should collect $1,500 in rent. That's just a quick, fast number. Now, the 1% rule goes in the trash can once you get up over a certain price point. Once you start moving in the 3, 4, 5, 6, 700,000s, you're not going to get $7,000 rent on a $700,000 home, generally speaking. But for a lot of our investments don't tend to be in that same price range. But it just kind of depends. The reason a lot of real estate investors use the 1% rule is because it's just a quick, easy way for me to be able to analyze an investment. I can say, okay, here's a property and it's listed for, just say 200,000. And I go into Zillow and I pull up and I see that all the rents in this area are 150 or 1,500 a month. I know that's not really it doesn't mean that I wouldn't necessarily choose it. It just means that I have to do a little bit more digging. Now, if I find another property, this one's listed for 200,000 and all the rents in this area run $2,200 a month, well, then I know that that's going to be a property that is going to be a lot easier to cash flow on. And so it's just a quick and easy way that a lot of investors use just to kind of analyze an investment on the run. And generally speaking, you're going to see a lot of investors that do their calculations kind of flippantly on the run, same kind of thing. And that's why the 1% rule is so used. It's just a benchmark for where folks can see this is how much it collects in rent. This is how much the acquisition price is. All right. So we've done gross rent multiplier. We've done 1% rule. Now I want to talk about cap rate. Now, cap rate is one of those that tends to throw a lot of people off, right? The only folks who are really going to talk a lot about cap rate tend to be very seasoned investors. Doesn't mean that you don't need to know it or understand what it is. But cap rate is one of those where, in order to calculate a cap rate, you have to take your net operating income, divide that by your total purchase price, and that gets your cap rate. And all a cap rate is that's your return on the investment itself, right? And so, your annual net operating income, generally speaking, that's rent less any expenses, and then you divide that by your total purchase price. So if I have a property and it has $10,000 in net operating income, and I buy it for $100,000, well, then that's a 10% return or a 10 cap. So we do want to be able to understand how cap rate works, but generally speaking, most of your buy and hold investors don't look at cap rate a lot, and the biggest reason is because that may give you a snapshot of what that investment does right now, but it's not taking into account property value appreciation. It's also not taking into account paying down the mortgage. See, as a buy and hold investor, you really make money in 3 different ways. So on one hand, you're going to have cash flow that comes in every single month. At the same time, you're paying off your mortgage, or your tenants hopefully are paying off your mortgage. And then the property is appreciating in value. So when you put those 3 things together, for a lot of buy and hold investors, just having a cap rate might be something that they want to know, but it's not necessarily the deciding factor, because you have additional ways that you're going to be able to make a better return. Now, you may not see that return until you actually sell it. Until I actually sell my investment, do I get to capture back how much I've paid down in the mortgage? Do I get to capture back the growth that I've had in property value appreciation over the years? But that cash flow is going to be part of that. And that cash flow is what's going to help you understand or calculate what your cap rate is. But all a cap rate is, that is just, that's how much of the property is being capitalized or paid off every single month in there. Next term that I'm going to talk about, and I hope your eyes aren't glazing over. I know it's very easy to kind of get lost on these, but I hope that you're jotting down notes. Next one is NIAF, net income after financing. This one's very, very easy to calculate. Your your net income after financing is simply your net operating income less financing costs. So let's say that you got a property that rents for $1,200 a month. You have a mortgage that's $800 a month. Well, your net income after financing, that's $400 a month. The reason a lot of investors use this term is because it's super easy. It's very easy to say, okay, I make 12, I pay 8, the rest is mine. It's not really, but it's just a quick and easy, down and dirty way to analyze an investment. And what I want you to think about is all these investments, all these strategies that we're talking, all these terms that we're talking about are just different ways to analyze an investment. So whether I'm looking at it from cap rate, whether I'm looking at it from net income after financing, whether I'm looking at it from a gross rent multiplier or from a whatever, no one ever uses just one term or method to analyze an investment. But when you can list all these out on a property, on an investment itself, it will show off your expertise. So the next one I want you to kind of talk, or I want to kind of talk your way through here, is cash on cash return. And so cash on cash, and the reason for a cash on cash return and why it's so important is a cash on cash return helps your investor understand how much money did I put into it versus what kind of return I'm getting back on it. It's talking about the leverage that you have in having a mortgage, and what that leverage really does give you. And so me as an investor, I can go out and I can put down 20% on a property. And on that 20%, I can go buy a rental property, or I can go buy that property out 100%. So I can go buy that property 100%, and now I will own one property, and I'm gonna, all that cash flow, everything is in there. Or I could take that same investment, split it up, and put 20% down on 5 properties, and now that cash that I put out, this is my cash on cash return. So in order for you to understand your cash on cash return, you take your net income after financing, which is kind of what we talked about before, and divide that down by your down payment. And so let's say I've got my net income after financing is $400 a month times 12, right? So that's $4,800 a year is my net income after financing. I put down $50,000 on a property. So if I put down $50,000 on a property, my net income after financing is $4,800. That puts me at a 9.6 return, which means that that's how hard my money is working for me. Most of our investors are going to, we find some folks that just want to buy cash for them, but most of the time it's going to be about leverage, being able to leverage those properties and how powerful that really is in here. So being able to put those forward is a real benefit to understand that. If you're not using leverage, then this calculation won't matter to you at all. But for a lot of our investors who are going to finance property, they want to see what that leverage really does give for them on here. So those are the main terms that we're going to use. That doesn't mean you don't have to understand other terms, right? A lot of investors will just use a very generic term called ROI, return on investment. But all a return on investment is all the terms that we talked about before, all those different ways of calculating. There isn't one ROI, okay? That just means this is what your return on investment really is. Normally a return on investment is the total wrap up at the end. Just being able to speak overall real estate investing language, understanding 1031 exchanges, understanding what REO properties are, those kind of things. You want to be able to speak the language of investing, but by and large, most real estate professionals already understand and know those. So I've gone through a lot of making your eyes, glaze over in talking about terms. And that's because I wanted to give you the core base knowledge, because I want you to be able to analyze an investment. I want you to be able to analyze an investment for you, or be able to analyze an investment for your clients. And so I am a napkin investor. And what I mean by that is, if I can't take a napkin or a scratch piece of paper and be able to figure out, is this a good investment, then this thing is too complex for me. And I find that that kind of goes for so many, especially of our buy and hold investors. If it is so complicated and convoluted and becomes a giant pain in the derriere, then a lot of folks are not going to mess with it. So, um, you know, when I analyze investment, I take a scratch piece of paper like this, and then all I do is I just draw a big plus, a cross right through the middle of the page kind of thing. Because what I want to do is I want to create 4 different boxes. So the whole idea here is that you have a property, you find a property, you think it might be a good deal. But how do I know if that's a good deal or not? So what I'd like for you all to do, please, grab a scratch piece of paper, kind of like me, because it's not going to do me any good just to kind of dictate this to you. I want you to pull a piece of paper out, set it down, grab a pen, and then let's start calculating an investment. Because when you can do this for yourself or you can do this for an investor, this is really, really valuable information that you can share or that you can have. So whether this is your investment or whether this is you teaching somebody else or this is you putting something out on social media to be able to get more business, the whole idea is that there's so many people in our industry that don't know how to analyze an investment and don't talk about these things. If you are wanting to work with investors, this is this is a golden ticket to really generate some really interesting conversations, build some relationships with investors, that kind of thing. So hopefully you have your scratch piece of paper, and then you got it cut into 4 different quadrants here. And so in the top left, I want you to put down income. All right. So let's say that you're looking at a property and the home is listed. Let's just say it's listed for $200,000, 3-bedroom, 2.5 bath. You're thinking about putting, 30% down, 20% down, whatever it may be. That is an important number to have because that's what you're going to be talking to your clients about. But the whole idea here is that you have to have some sort of property in mind. So whether you found it through the MLS or whatever kind of thing, but you have to have a property. So on our property, I'll just take one of our former properties. It was listed for 200,000, 3-bedroom, 2.5 bath. So the top left-hand corner of our paper here, this is where we have income. And so under income, you're going to have, of course, your rental income. How much does the property rent for? And as weird as it sounds, the easiest thing to be able to calculate here the easiest way to calculate it is just to go to Zillow. You go into Zillow, you only choose rental for rent. Don't look for sale, look at for rent, and then zoom and then focus the map on where that subject property is. And what you'll see all these other rental properties around it, the size, the bedrooms, the bathrooms, the square footage, and how much they're asking for in rent. It's just a down and dirty, really easy way. I normally take somewhere in the middle. You'll find some, like on this property, we came in at $2,200 a month, and they had properties that were listed that were renting for $2,000 and properties that were renting for $2,500, $2,400. So we just went with a $2,200 rental income. So I normally just kind of take middle of the road. I want to be realistic about it because this is an important number. So go in and I love being able to just go in and pull that up. And like I said, I normally use Zillow for that. So if there's anything else with a property that you can generate income from, you want to make sure that you're taking that into account as well. Like if it's a multifamily, do you have laundry? If it's if it's a single family, do you have a storage building out on the back or a garage that you might be able to lease out in addition to the property? At the end of the day, you just want to get total revenue, rental income for what this property can generate. Now, in my example here, we don't have any other rental income, so the only thing we have is just our base rent, and that's going to be $2,200 a month. So the top left-hand corner, we just have, rental income, $2,200 a month. Now, in the next section down, this section is, I just want you to put a label in there and write expenses. And this is where you put down what are the expenses in operating a rental property. And so, very first one is going to be taxes. Now, the easiest thing to do is just pull up, go into Georgia MLS or FMLS or whatever, realist, doesn't matter, and see what the property taxes are for the property. Here is a caveat though. If the last taxes being paid was being paid for owner occupants or primary dwelling, that kind of stuff, your taxes will go up the second year. So just be realistic about that. But normally I just go in there, see what taxes are running. And so on this particular property, taxes were $150 a month. Underneath that is going to be insurance. And so you can call your insurance agents, you can get an average price. For us, because all we're insuring is just the building. We're not insuring contents at all. I expect that the renters keep their rental insurance. I'm also not insuring the land. So, my insurance tends to run about $100 a month. So now under insurance, put down $100 a month. So we got taxes, insurance. We also want to make sure, like are utilities included? Electric, gas, water, sewer, those kind of things. If they are included, then that becomes an expense for you. For most of our residential properties, that most of the time the tenants are having to take care of this on their own. But if it is in one of those cases, you want to make sure you put that down there. The next expense is always going to be HOA, if there is one. Take this as a piece of advice. If the neighborhood, if the home that you're investing in or interested in investing in has an HOA, then what we do is we include lawn care as part of the rent, and then we add that onto the rent. And so if it was going to be $70 a month or whatever else it might be, if it has an HOA, please make sure that lawn care is included. Like I put that as an expense, but I also up the rent as well to offset that cost. The reason is because if they don't cut their grass, which they won't cut their grass, then you're going to get fined from the HOA, and then getting that back from the renters is always tough. So for us, if we have a rental and it's in an HOA, then lawn care is included. So I like to know if there's any HOA fees, if there's any lawn care. Like I said, if there is an HOA, then I will include lawn care in there. And on this property, I didn't have either one. Next is vacancy. And a lot of your investors will not budget for vacancy. And I think that that's not smart. Now, we have been blessed to have some tenants that have been with us for very long. We also had tenants that were really transient. You just don't know. I mean, we do our best to try and vet people. Most of the time, the challenges that we've had with tenants is when we broke our own rules about, someone met us and they were really nice and they had kids, and, we listened to our heartstrings instead of common sense. But the reason is that you want to put some sort of number in for vacancy. And for us, it's 5%. Like if you just put 5% into vacancy, you're going to be able to put that money aside. And so, 5% of our rental that's going to be $110 a month, off $2,200 a month. Next expense is going to be CapEx, which stands for capital expenditures. At some point of owning this home, you're going to have to replace a roof or an HVAC or something big. You're going to have to replace windows, those kind of things. That's not part of normal, wear and tear, those kind of things. If you don't have something set aside for that, then when these expenses come, it can make or break you. And so we put a little bit of money every month into our CapEx fund. Matter of fact, when we do our investing, we have a business checking as well as a business savings. And then every month, things like vacancy, repairs, capex, all those go into the savings account to build up that nest egg in case something happens. In addition, the next one that the next expense you want to be thinking about is going to be repairs. And how much do you think repairs are really going to run? Do I need to put in $25 a month, $50 a month, $100 a month, whatever it may be, in order to maintain repairs on the property? Next expense that I want you to list is property management. That could be zero, or it could be a number. We see that a lot of property management companies run between 7 and 10% of the monthly rent. 8% is kind of a normal number. 8 to 10 is really, really common in that range kind of thing. You're hard to find anybody at 7 anymore. But 8 to 10 is pretty consistent on what property management costs. If you're an investor like me who doesn't like to have to go and collect rent checks and that kind of stuff, a property manager is going to be really crucial for you. And so for me, like if I had an investor, if I had a property manager and they were 10%, the monthly rental income is $2,200. So my property manager expense would be $220 a month. Last expense is going to be mortgage. And so the mortgage is basically just going to be, like you can calculate, there's a bazillion mortgage calculators out there that will help you calculate how much that mortgage is going to be. Put in what your down payment is going to be. For most of your for most of your residentials, you're going to need 20% down, generally speaking. Now, if you do have a client that is trying to do, say, a quad, a duplex, or a triplex, and they're going to live on part of it, then they could possibly get an FHA. But generally speaking, they're going to need 20% down. The more money they put down, the lower their monthly mortgage is going to be. So, for us, we tend to like to put more than 20% down, but it just kind of depends on the scenario. On there, the more they put down, the lower their rent is. So for in our particular example here, we put 30% down on that property, which gave us a monthly mortgage of $935 on that property. So at the end of it, you add it all up and you come up with what your total expense is. And so on this particular property, if I add up taxes, insurance, all the way down through, I get a total expenses of $1,665 a month. So right now I've got income for $2,200 a month, expenses for $1,665 a month. And so that takes care of the first two boxes on the left-hand side. Now, up in the top right-hand corner, this is we want to start looking and start evaluating our numbers. And so the first number that we're going to start breaking down is cash flow. This one's super easy. And so all those terms I threw at you earlier, now is when you're going to start putting all those, we're going to start doing those calculations all down the right-hand side. And this is what helps an investor to be able to make a decision. Do I want to buy this property? Here's how much it generates. Here's the expenses. Then over here on the right-hand side, here's all the numbers that I need. And so the first one we're going to look at is cash flow. Remember? And so cash flow is income less expenses. So $2,200 a month, $1,665 in expenses. That means that my cash flow is $535 a month. Okay? We're never just going to take that one number to say, okay, I'm going to buy that property. You need a lot more information. So the next number that I want you to calculate is what's called NOI, net operating income. And basically, net operating income is all your expenses, not counting rent. So less your rental income. And so if you took all that, so if you took your income less all your expenses that weren't rent. Hope I'm making that really, really clear. So of that $1,665 a month, if we took the $935 off that's how much that works out to, basically $1,470 a month in net operating income, NOI. And if you divide that by 12, our annual NOI is going to be $17,640 a year. And so this is, we need that because remember, we're going to be calculating out how hard our money's working for us, how hard our mortgage is working for us. That's why we have to have a net operating income that doesn't include rent. And so again, all net operating income is our income less all those expenses that we listed out, not counting mortgage. So again, that's going to be $1,470 a month or $17,640 a year. Again, so that's the next one on our list. Last one in the top category, top section up here is going to be GRM, gross rent multiplier. And so on here, we purchase the price, or we can purchase the price of the property for $200,000. Our annual rent is $26,400. That means that our gross rent multiplier is 13.2. Again, not something I'm going to use to necessarily decide, but will be that's not going to be the only thing I use to decide I want to buy this or not. But it's an important thing for some investors to have. Moving down the page, 1% rule. Okay, so I just normally 1%, and so 1% rule says that anything over, if I buy it for $200,000, anything over $2,000 a month is a win, and my rental income is $2,200 a month. So I'm better than my 1% rule. Next calculation is appreciation potential. I like to list this, but this is one where there's not a true calculation on this one. This is about you using your average, like put your realtor hat on for the most part, because I like to put down what the appreciation potential is. We know that the average is 4% a year. I normally put down 5% just because I feel like most of my investments, we tend to be in high growth areas, those kind of things. If you have a property that's not going to appreciate nearly as much, put that down too. But like for me, I generally put down 5% property appreciation down there, because again, that's another number that if I don't list it, the investor may not realize it, may not think about it, right? So I want them to see how much their property is going to appreciate every year that they own it. Next calculation. And I know it's getting long, but again, the whole idea here is that you want to be able to analyze this investment and should you buy or not. And so I do want to help you calculate cap rate real quick. Again, cap rate, the easy one on cap rate, all right, that's your NOI divided by your purchase price. So we already calculated our net operating income, or our NOI, earlier. So our NOI earlier is $17,640, and we divide that by $200,000 because that was our purchase price. So if we take $17,440 divided by 200,000, it's going to come out with an 8.82 cap rate. And so if your cap rate goal was 8%, then this is a better deal. If your cap rate goal is 10%, or your internal rate of return is 10%, well, you might want to say, okay, this is not this is what my cap rate is, but that's on an annualized basis. We still have property value appreciation, as well as we're going to be paying down the debt. So, for me, that's still, again, there's not one number that we're going to use, but some investors will be very, very tied up on cap rate. Next calculation we're going to put out here is cash on cash return on investment. And so on this property, we said we were going to put 30% down. And so on a 30% down on a property that's $200,000 means that we're putting down $60,000. In addition to the initial down payment, you want any other expenses that cost you in acquiring the property. And so on this property, we had $3,000 in closing costs we had to pay, and we spent about $7,000 in repair in order to get the property to where we could actually rent it out for that number. So all in all, our total investment was $70,000 on this property. And so on a $70,000 repairs, my cash on cash return starts with my total investments, $70,000. Now, if I go back all the way to the very top and I say, look, my cash flow was $535 a month. Okay, that's my total income less my expenses. That's 535. I divide that by 12. That means my annual cash flow is 6420. 6420 is my annual cash flow. I divide that by what my total investment was. My total investment was $70,000, right? So my total cash flow divided by my total investment, 6420 divided by $70,000 means that I'm a 9.2% cash on cash return. So when at this point I have, here's my expense, my income, here's my expenses, then here's all the calculations on this other side to be able to analyze an investment. This is a when you take a property and you break it down this way, and you have everything that you need to do this as a real estate professional. You can go and figure out how much what the rental income is going to be. You can calculate the expenses; they're all very easy to calculate out. And now you can calculate all the numbers that you need and to be able to address the decision making options for your client or for yourself, for that matter. See, for so many people, they don't break this down. There aren't. I mean, there's a handful of real estate professionals that will do this for a client, and so I do think that if you want to impress an investor, do this for any property. Like the first time you do it, it's going to take you a little bit of time. You may need to watch the video again, those kind of things. But take our investing class. I kind of teach the same thing in our investing class, but like when you can analyze an investment like this, it can be so beneficial because now as an investor, I have I have everything I need to make a decision. A lot of times you have investors and like they just don't know how to decide, or they don't have enough information to decide. Well, you just took that completely away. Now they have everything that they need to be able to decide, am I going to move forward on this property or not? The other thing is like on one hand, you can take a property that one of your investors is interested in, break this investment down, and then show that to them, blow them away. They'll be super impressed with the fact that you can do this. The other thing you can do is to go and do this on potential properties. So you're out searching through the MLS and you find a property out there that has, a whole set of opportunities out there, kind of thing. Oh, this house is listed for this number. It's listed for 175. It's a 3.2. You can calculate all that kind of stuff, and then you take a picture of the home, do this investment, or do this analysis. This is how much it makes in income. These are all the expenses. Here's all my cash flow, NOI, gross rent multiplier, 1% rule. List all that out and then put that out there. Say put a post out that says deal of the week, right? I found this property. Here's a picture of it. This is what you need in order to make a decision on this property. Contact me if you would like to see this property, right? Because the whole idea here is you want to like I love working with buy and hold investors. Love our buy and hold investors. Like one of Ming's, Ming has an investor that bought 22 houses, I think, over a year or so from her. Because once you build a level of trust with these investors, especially for your buy and hold folks, they buy again. And as soon as they get enough money, they buy again. As soon as they get enough money, they buy again. And so being able to build that and show, your level of expertise, show that you know what's going on, be able to really talk about these numbers and to be able to present these numbers. I can post and show, I can throw this into social media. I can go, you could do this, go Facebook Live and do the same thing, break down an investment, the same way I'm doing with you. You could do that, break it down. You could send this out to everybody inside your database. So if you have folks who are tagged in your KV core or your database who are investors, you could send this out to them every single week. There's a lot of opportunities that you have to actually go out and grow this kind of business. You know, there's a lot of investors out there who are like, well, what have you done for me lately? And they're not necessarily real loyal. When you put this kind of information out there, automatically folks are going to be really, really drawn to you, and you're providing value right up front. But you can do this on a bulk scale out here. I see a lot of value in putting that out to a lot of people, and doing this to be able to generate business. One other thing that I will kind of throw at you guys that I would like to talk about, in addition to what I just did, is if you're a realtor and if you'll go into RPR, and so just go into narrpr.com, and if you pull up a property in RPR, let's say that you find a property that you're interested in doing, pull that property up in RPR, scroll down on the right hand side, and you'll find a tab that says Valuate. If you click on the Valuate tab, there is a property analysis tool that is part of RPR. And so all you do is just go into Valuate, and they have a long-term hold analysis. They have, it breaks the whole investment down for you. It will give you 1, 3, 5, 10-year cash flows. All you do is go in, and a lot of the same numbers that we just went through, as far as being able to break those down, share, calculate all those kind of numbers that I just did with you. I think it's important you understand what those numbers are and how you could calculate them. The thing I like with Valuate is you go plug the numbers in, and it is definitely a garbage in, garbage out. If you don't put the right numbers in, you're not going to get the right numbers out. But if you go in and you put those numbers in, then you can generate a Valuate report on that same property, and it doesn't cost anything. They'll only let you save 5 properties. It's not a big deal, but you can go in and put in all the numbers, same numbers that we were looking at in doing our analysis, our cocktail napkin analysis. You can go in and it gives you this really nice spreadsheet, puts it in there, lays it all out for you. And then you could share that out as well. The only challenge is that property, or that always lists the address of the property at the top. So if you're going to be using this to try and generate business, don't give it away for free. Give the analysis away. Don't give the address of the property away for free, kind of thing. They have to contact you because you want to help them find and buy this property. You don't want it to be, hey, like you don't want an investor to call their regular agent. Or, you want them to reach out and engage with you. So, this is primarily, for this is going to be about what we're talking about for buy and hold investors. There's a lot that goes into the actual, do you want to do property management? Do you not want to do property management? All these different kind of things. And there's a lot of other ways that you can invest in real estate. Whether you want to do tax sales, whether you want to do flips, if you want to do buy, repair, and hold. There's a lot of opportunities in different categories. I just find that for a lot of real estate professionals, just normal realtors, when you can throw this out there, it's not super taxing. You're not having to worry about repairs. You're not having to worry about finding contractors and doing all this other kind of stuff. You're just finding property and throwing it at folks, doing some analysis, and then presenting opportunities to clients or potential clients to be able to help them reach their investing goals.